This is a very quick revision about issue of shares. Okay, you can understand this video only if you are through with your concepts. So it's a last minute revision when you're going to give your accountancy paper, ISC or CBSE. You can refer to this video. Shareholders are nothing but owners of the company, and the money that they invest in the business is in the form of shares. And we are talking about how does the company issue shares. So when we say how does a company issue shares, that means how does the company create capital. Share capital is the capital of the company. Owners are the shareholders. So there is a process of share issue. First, the company offers the public shares. When the company is offering shares to the public, the company is issuing shares. Then people will apply for the shares. Once the people apply for the shares, that means they are subscribing for the shares. After people apply for the shares, we allot them shares. When people apply for the shares, they pay us money. Money is coming in, so at that time we say bank debit. When we allot them shares, we first call for the money and then they pay us. Just keep this process in mind. Okay. After we allot them shares, we do our first, second, and third call. So the process of share application starts with you offer the shares, people apply for the shares, you allot them shares, and then you will call for the money. One thing also you need to note over here is that whenever you call for the money, you create capital. And whatever you create as capital, capital cannot exceed the face value. There are some concepts that is related to shares issues. So what is the face value of the shares? The price which is on the face of the shares, the list price, is called the face value. Capital can never exceed the face value. What is premium? Premium is the extra amount you charge when you issue the shares. Suppose your shares is of rupees 10. When I say share is of rupees 10, the face value is 10. I sell at 15. That means face value is 10. Selling price is 15. Extra amount that you have charged them is $5. So premium is $5. After I offer the shares, people will apply. Application is the first step where people apply for the shares. Whenever people apply for the shares, I receive money. So I would say bank account is debited because money is coming in to share application. Okay. Whatever money you receive for how many number of shares you receive. Face value, the list price, premium, extra amount you receive or you charge when you're selling the shares. Application, people apply. After people apply, that means you're subscribing for the shares, you allot them shares. So allotment is giving the shareholders shares. Okay, what is calls in arrears? You are asking the people, you're asking the shareholders to pay you the money, but they are not paying you or they did not pay you. So you have called up the money, but the shareholders did not pay you or you've not yet received the money. Then you create an account which is called the calls in arrears. If the shareholders have paid you in advance, then there is an account which is calls in advance. One thing you remember, whenever you call money, you create capital. Call money, create capital, capital is credited. Okay. Then there are these types of share capital. You should know this because they ask you a question to make a balance sheet format where all these headings come into consideration. Authorized share capital, registered capital, nominal capital. It is the maximum number of shares that the company can sell during its lifetime. Okay, I can sell, but I sell or no is up to my decision. Issued share capital, the shares I actually sold, or I would say the shares I actually offered to the public to buy. Subscribe share capital, I may sell any number of shares, but what the shareholders or what the people will actually buy is called the subscribe share capital. Okay, subscribe and fully paid up. People have bought the shares also and they have paid for it also. It is called subscribe and fully paid up. So these are the types or the headings that comes in your balance sheet. Authorize the maximum that you're allowed, issued that you offered to the public to buy. Subscribe is what they actually buy from you. Subscribe and fully paid up is that they bought the shares and they've also paid for it. We take this with a short example. Say, for example, you've issued 10,000 shares and people have bought all the shares that you have issued. That means this issue is fully subscribed. It is fully bought. Whatever you have issued, everything is taken by the public. Issue is fully bought. It is fully subscribed. You've issued 10,000 shares, but people have purchased only 9,000 shares. That means the issue is undersubscribed. You have issued 10,000 shares, but people have applied for more than 10,000 shares. That means the issue is oversubscribed. When there is oversubscription, you can distribute the shares on pro rata or refund the extra money that you have received or adjust it against the future payments. We'll discuss this later. What is a payment schedule? When I talk about a payment schedule, you should know the steps that is involved when you issue the shares to the public for sale. First, you give them an offer, then they buy it, then you allot them the shares, and then you call for capital for the remaining money. So, first, you offer the shares to the public. When you offer the shares to the public, it is through prospectus. Then people will apply for the shares. You have to make a schedule. Suppose your share is of rupees 10 and you are issuing it at rupees 12. That means you are charging 2 extra. Whatever extra money you are charging is called the premium. Premium will go to a separate account which is called the share premium account or the securities premium account. Capital can never exceed the face value. Face value of the share is rupees 10. So your capital can never exceed rupees 10. This I am talking when we are talking about one share. Okay. So application. You decide a schedule that at the time of application, people would pay 2 per share. When I am allotting the shares, I'm asking for 5. That means I have split it up. They're going to pay me 5, including the premium. So 2 would go towards premium and 3 would go towards capital. Then I call for the money. Whenever I call for the money, you call money and you create capital. First you call money, then you create capital. So whenever I call for the money, I will write this. If they pay you, it would be subscribed and fully paid up. If they don't pay you, then you will have an account which is called the calls in arrears account. If you wind up the entire payment in the first call, so the first call will be first and final call. If you do a first call and a second call and you wind up the payment in the second call, then your call will be named as second and final call. Things to note over here is, when do you create capital? You create the capital when you call for the money. When you call, you create capital. When you create capital, capital account will be credited. When you cancel capital, capital account will be debited. canceling the capital is called share forfeiture. Some important terms that you should remember. First is capital reserves. What is capital reserves? It is reserves created out of capital profits. Reserve capital. Reserve capital is that portion of your capital that you can call up only when you are winding up the company. What is the minimum prospectus? Minimum prospectus is minimum subscription. There is an amount that you should mention in your prospectus that I am going to issue these many number of shares and I expect that these many people would subscribe for my shares. So that amount of shares that must be subscribed if I have to create the capital. If my expectation is not reached, okay, I have not received the minimum number of people that should buy the shares, then it is undersubscribed. So if I have not received the minimum subscription, I have to refund the money that I have already received in 120 days.